Good morning, everyone. Welcome to Main Management's weekly market note for the week of April 11th, 2025. I'm James Maxwell, VP of Research here.
And I'm Alex Dippery, an analyst on the research team at Maine.
Yeah, well, very, very interesting week last week. Probably one of the more interesting weeks we've had in the past few years. Just to get started here, just hopping in kind of on the regular updates. You have the year-to-date and weekly performance for broad global indices and sectors. The big story last week was a reversal in some of the strong tariff moves from the Trump administration, specifically on countries outside of China. You saw a removal or a 90-day pause on those reciprocal tariffs and just leaving that 10% baseline tariff, which was very, very welcome by markets. Leading the move up was largely what actually were down the most, including tech, industrials, financials, as you can see there. But still on a year to date, a lot of these sectors are still in the red. You only have consumer staples and utilities that are in the blue in terms of in the green, I should say, in terms of sectors. And then on the broad global indices side, it's Europe and developed markets, and fixed income is just barely positive for the year. So you saw a huge kind of reversal, but even still broadly negative. I think that's just speaks to the magnitude at which we've been down year to date. Going to the recession dashboard, we had updated a few of these last week, but just to reiterate, we moved the consumer to blue. It was previously green. We moved sentiment, same thing, to blue, previously green, and PMIs as well to blue, previously green. Speaking on those for a second, and Alex can chime in here as well. I think there's a lot of uncertainty out there. Our view is that in such high uncertainty, we can't really have strong conviction in either way. On both the consumer and PMIs, we see those as kind of slowing, not crashing. The consumer specifically, you've seen maybe some kind of drawing back due to broader labor market slowdown, due to tariff concerns. In times of uncertainty, people are, not going to make big purchasing decisions or are less likely to. And then PMI is kind of similar idea on the business side. You saw a lot of these PMIs, both like the regional Fed and the ISM, and the S&P ones, all kind of pointing in the direction of uncertainty and not really wanting to make big, capex capital expenditures, big business decisions when the week to week or even day to day or minute to minute uncertainty is so high.
Yeah, and especially for the consumer sentiment PMI, the things that have recently been downgraded.
Mm-hmm.
Where we go from here is very path dependent.
Yeah.
So we'll sort of have to wait to see what policy does and then have a clearer idea of what we can expect from these various indicators.
Yeah. On sentiment, just to highlight that, it's something we've talked about a lot. It's one of those that is a bit of a contrarian, in terms of the markets. Sentiment is something that you want to buy when it's negative, and maybe sell or be more cautious when it's overly positive. So right now, you had this massive crash in sentiment kind of across the board, across most indicators. In our view, it's not something that's going to spike back up, back to all-time highs, just given the probably prolonged uncertainty. But it's not something that we think is going to also kind of crash further. I think it's gone down a lot. Sentiment's gone down a lot. It's hard to say, okay, it's going to go down even more from here. Going to kind of the data this week, as I mentioned earlier, the big thing was that move off of tariffs, or I should say the removal of tariffs or pause on tariffs. And you actually had one of the largest days on record for many of the headline indices. For the S&P, I believe it was going back to 2008, was the only other, or the last time the S&P was up more than 9.5%. I think the NASDAQ being up 12 was since '02, if I remember correctly. So you've had these kind of massive, or you had these kind of massive moves. I think one thing that we want to kind of touch on is these are charts of these 1 day moves, and the left is the S&P, and the right orange is the Dow, going back the past 100 years. And basically, one thing that we've seen, and this is kind of common, is that these massive spikes up are usually grouped in with massive spikes down. You just kind of have this natural, return, call it reversion to the mean, or volatility leads to more volatility. So you kind of see these clumpings together, whether it's '08 or '02, or things like the Great Depression, where you saw massive, massive spikes both up and down as the market's trying to figure out really what's going on.
Yeah, and as James mentioned, this was the largest intraday move since the Great Financial Crisis.
Yeah.
Goldman actually has on their research portal a liquidity tracker, which market liquidity levels are at the lowest they've been since COVID, and so that's something that's been exacerbating these moves up and down, is slightly less liquid market. And so going forward in the next couple of weeks at least, one thing that we can expect is that policy announcements in either direction or news headlines will probably have the potential to move markets a little more than you would normally expect. So that is something to watch out for as we're going forward with whichever direction it may be.
Yeah.
You're likely to see a lot of these larger moves.
One thing that we've looked at is just naturally in these types of bear markets, in these broader sell-offs of risk assets, you get less liquidity across the market as a whole. There's just not the same level of essentially marginal buyers and marginal sellers that are price making. So what ends up happening is that you end up getting these really, really exaggerated moves to both the upside and the downside off of any sort of headline, any sort of kind of news announcement. And you saw this last week, where this is probably an oversimplification, but think of it like these the investors are taking the chips off the table. There's not a ton of kind of exposure out there, or people willing to take on the risk. So when you get these headlines, you have these massive moves as a response, because people are off sides, they're out of the market. There's not the same level of kind of, like I said, price making that there might be in just a normal environment.
Right.
Moving to the big other piece that we were looking at this past week was yields, and very kind of surprisingly and contrarian to a lot of what people were expecting was that the 10 and 20-year yields were rising the past week or so. You saw I think on April 3rd, right after the Liberation Day, yields hit kind of the 10-year yield hit that 4% mark, which the Trump administration, specifically Scott Bessent, has said that he hopes to get below that 4%. So for a second there, he got his goal, and then you kind of immediately saw a reversal back up, which has hurt the fixed income space, or I should say U.S. Treasury space as a whole. I know that you had some thoughts on that.
Yeah, so I mean, one thing that's been really interesting about this move up, aside from just the sheer speed of it, is that it's coming along with heightened recession fears, which you intuitively would think would do the opposite, would continue to push yields down. And so one question it does raise is, what is causing that? One factor that could be contributing in part is to some magnitude a rotation away from U.S. Treasuries as your safe haven asset. So if you look at the dollar index as a whole over the same time frame, it's down 3%. But if you look at the dollar against the Swiss franc, it's depreciated 5%. In part, this is indicative of more flows into other safe haven assets, such as the Swiss franc, and potentially out of U.S. Treasuries.
That's been a narrative, that there's this kind of de-dollarization, maybe the end of U.S. dominance. I wouldn't say our house view is probably not that extreme. I think this is probably more on the margins of why own U.S. Treasuries when there's uncertainty in the U.S. market. Just kind of very plain and simple. when you could own francs or other
Yeah.
government bonds. And then the other thing would be, I think there's two other things that I was looking at. Kind of what I mentioned earlier, the lack of liquidity. You get these extreme moves, kind of on any sort of move in either direction gets amplified because of a lack of liquidity, and that gets tied in with we saw some headlines last week and some articles on some of the deleveraging you've seen in the Treasury space, where there was certain hedge fund popular trades that because of the exaggerated moves in risk assets and in equities, you saw some unwinding kind of across the board of these positions,
Right.
including in treasuries. So that it's an unwinding of a move in an illiquid market. You're going to get
Yeah.
these kind of exaggerated moves. So our view is that kind of on a longer term basis, yields should probably be in the 4 to 4.5% range, maybe 4.25. So certainly been a very exaggerated. I keep using this word exaggerated kind of move where it's probably not sustainable. I don't know if you have any other thoughts
No,
on that.
I'd agree with that.
Yeah. One thing that we want to talk about on the economic data, the big piece last week was the CPI that came out, and obviously that's measuring inflation. It was the first negative monthly reading in, I think 2 years, and the largest actually decline since COVID in that month over month. So this is part of just fits in with the broader story that we've been talking about of disinflation. I think this is kind of years in the making of, you had the Fed rate hikes, you had rental inflation, sticky inflation, years and years of kind of coming down. Finally, you're kind of seeing it ticking down at a faster pace, especially that core CPI, which removes food and energy, which are known to be more volatile. You can see that bright green line on the right actually kind of breaking to a new low since before the whole inflation spike. So I think broadly this speaks to what we believe, which is this inflation is happening, inflation's moderating. It might take, or it has taken longer than expected, but all of the drivers are still there.
Yeah, and there's obviously been some more noise recently, but this does support our longer term view of inflation moderating, coming down. Even the tariff concerns with regards to inflation would be a one-time spike. So, broadly speaking, we see this trend continue.
Yeah, and I think those one-time spikes are important. I think the Fed has acknowledged that as well. One thing that you might not have seen is in the Fed's March meeting, they have their summary of economic projections that they do once a quarter, and they look out over the next few years and say, what do we think inflation is going to be? What do we think, GDP growth, et cetera, and what do we think the Fed funds is going to be? They actually rose their inflation estimate for 2025 while keeping the Fed funds estimate or projection the same, which to me says they acknowledge that inflation might be higher under tariffs, and obviously this was pre-Liberation Day, even last week when some of those were peeled back or delayed. But even still, it's kind of the broader philosophy of understanding that inflation caused by tariffs is a one-off price increase rather than hopefully rather than a sticky longer-term driver of inflation. I think they agree with that broadly. On kind of deeper in CPI, I think we'll keep these brief, but two things that have been kind of a focus: food prices. You've seen eggs in the headlines the past month or so. Those have been coming down. Even still, you kind of seen some elevated measures because of lags and delays, and this is March data, so there's kind of some noise still there, but it broadly is still fine. And shelter has been the other big topic, and that's just been steadily coming down. As I mentioned earlier, it's one of those sticky parts that takes years and years to kind of flow through, but finally getting back to a more reasonable level.
Yep.
On the PPI, that's the other inflation measure that was released last week, Producer Price Index. Just gives you more of an idea of what's happening across the board. Also deflationary. I think this is overall positive for the core PCE, which is released at the end of the month. That's kind of the Fed's preferred inflation measure. It's a cleaner measure of actual like true inflation that consumers feel. CPI and PPI are faster to produce, but they probably aren't as clear or aren't as they're more noisy in their measurements. So what economists will do is take both of these and kind of be able to produce a pretty accurate estimate of core PCE, which is like the one that matters the most. So basically, the takeaway from all of this is it's probably positive for core PCE. It looks like the reading month over month will be less than 0.1%, which is quite low and below that 2% annualized measure. The actual year over year is higher, but the trend is still there.
Yeah, and there's a good point at the end of this slide with the Fed. There had been some murmurings of a stagflationary scenario, which would have made it difficult for the Fed to navigate whether to cut, keep rates the same. There is more leniency now with the Fed being able to cut if they don't have to worry about the inflation side of that and can just focus on stimulating the economy.
Yeah, it's much easier for them to be proactive with their policy if inflation is not a huge factor. And I mentioned that earlier, where they probably will be able to look through some of the one-off price increases. It's unclear how actually in the time of crisis what they'll do, but that's at least what they've kind of signaled.
Yeah.
One of the other economic readings we got that's been closely watched has been the University of Michigan's consumer sentiment. That declined even further in April. It's at its lowest point, I think, since May 1980, which is insane to think about. One thing that we've been discussing internally, this actually happened last year, but they've moved from being purely phone-based surveys. So they, basically what they're doing is calling, or previously what they were doing was calling across the contiguous United States and asking them different questions to measure their sentiment and then overall creating an index based off of that. Last year, they moved to a web survey off of phones, and there's been kind of an increase in volatility on the margins, as well as a broader decline in sentiment that's been associated with web surveys. They say that it's pretty well correlated. If you actually look at the differences, there's again, on the margins, it might be slightly lower or more. People are more willing to answer negatively when they are not actually talking to someone, when it's just filling out a box on a website. So it's just something to keep in mind, that things like inflation expectations, things like sentiment surveys, they change over time, they evolve. I think that the fact that it's the lowest since 1980, I mean, that's pretty. It's a pretty insane stat to me.
Absolutely.
Do you have any
thoughts
on that?
I mean, there's a couple other things here too. So for one, looking at the graph on the right, you can see that the inflation expectations have absolutely shot up.
Yep.
Which is relatively detached from what the actual data has been showing. Part of this is probably attributable to people seeing more headlines about tariffs, more headlines about inflation, which of course is amplified by social media and how people are consuming media nowadays.
Yep.
Another thing that's probably leading to some stickiness as far as negative sentiment readings is the huge divergence you see from a partisan standpoint. Political views play a huge role in sentiment. The difference in headline sentiment as well as inflation expectations is pretty drastic by a political party. And so for an event like this where there's so many policy headlines, it's so centered around inflation, and there's a lot of partisanship baked in, you could expect it to be a little bit depressed for longer.
Yeah, we don't have the chart up here, but there's a chart that we've shared previously where the University of Michigan actually breaks sentiment, inflation expectations, et cetera, by political party. So part of their question is, what political party do you identify with? And it's almost funny how when every election and the recent election even more so, whatever party's in power, is absolutely happy before the election, and then when the election happens and the power swaps, their sentiment collapses and the other party's sentiment explodes. So it's kind of like, it's almost like it's comical to see how much sentiment, how you're feeling about the economy, how you're feeling about things like inflation expectations, etc., are purely driven by what political party the person identifies with.
Yeah, I mean, you see literally on the graph a complete 180.
Yeah.
So
moving to another sentiment indicator, the NFIB, which is the sentiment of small businesses. This is one of those that absolutely, rocketed up when the election happens. Kind of speaking to what we were just talking about, where you saw these massive spikes in sentiment. Same thing happened in 2016 when Trump got elected for the NFIB. And you've kind of seen a reversal here in the past couple of months. Mm-hmm. I think it's funny to think about this sentiment survey almost as a proxy for a lot of the call them Trump trades that happened right after Trump got elected, whether it was crypto or, small cap growth or these kind of very, very Trump sensitive investments. And you've kind of had a reversal in a lot of those. Look at like Tesla, for example, or Bitcoin or crypto as a whole, things that were right after the day that Trump was elected, you saw spike up. And then for the months after that, really, really had some excitement around them. You've seen a reversal broadly in a lot of these assets. And, maybe they're still above where they were pre-election, but a lot of that and those animal spirits, a lot of that kind of excessive optimism has been kind of brought back down to reality. Yeah.
So, as you mentioned, part of this is probably just a reversal due to maybe what was an overshooting before. It's worth mentioning that we're still above where we were pre-election, but maybe the initial reaction was just a bit too strong. The other component is that for small business owners, it's probably very difficult to operate in an environment where there's so much uncertainty about where policy will end up. So you'd assume that when that gets cleared up and when we know for sure what the tariff situation will be, this will probably settle into where it might stay.
Higher than average, I would assume.
But in the meantime, it's difficult to make decisions about how to run a business when you don't know so much about what the future will hold.
The other chart on this slide on the right-hand side is a measure. They ask, what's the single most important problem that you see within your small business? And for a long time there, it's been that green line, which is inflation, was by far the largest issue that people saw. And you've actually seen that come down as kind of what we were referring to earlier, as inflation broadly has come down, and you've kind of had this broader moderating or disinflation. Now the largest problem is quality of labor, which is kind of interesting to put into perspective with the labor market cooling. You still have kind of this issue where openings are high, businesses need high quality labor, but there's kind of an imbalance where they can't get the exact type of people that they want for the role, or there's broader imbalances where there's openings in certain sectors and it's really tight in others. So that's just something to keep an eye on. That's basically it for this week. One thing I did want to mention that I didn't mention earlier was over the weekend we had one big headline was on the tariffs on semiconductors and electronics broadly. You saw first this exception came out saying that electronics, including phones, computers, semiconductors, etc., were exempt from the tariffs, and that kind of you saw this massive move, at least in the overnight or over the weekend, and kind of people saying, "Oh, this is really good for the technology sector and kind of AI, and these are really important things that you want to keep free trade in." And then you saw kind of conflicting headlines where Lutnick came out and said, actually, there will be tariffs on these. It'll be part of something separate. And then Trump said there will be tariffs. So there's all this kind of headlines where it's not a coordinated kind of policy maneuver. And I think speaking on the uncertainty and the lack of ability to plan and all of these kind of issues that we were just talking about with small businesses and broader, that is a really good example where
Right.
if you're a technology company and you rely on imports, it's like 1 hour you're like, yeah, I can have all my imports and I won't get tariffed, and then the next hour it's, oh, they will be tariffed by 100% or however much it ends up being. Like, it's very hard to plan in this environment, which obviously is not a good thing for businesses.
Yeah, I mean it's impossible to make decisions. There's such a wide array of possibilities that you sort of just have to assume that it'll get cleared up
Hmm.
later. The markets seem to respond positively net, at least on the open.
Yeah.
Tech was up the most of any sector. The intraday has been a little choppier at the
Hmm.
time of recording, at least, but the initial response seemed positive.
Yeah, I mean, I think overall, if you think about what these tariffs are actually meant to be, um, at least one of the views is that they're trying to position the US in a more advantageous position for the next 100 years, not just for the next 4 or 8 or 12. And things like, continued technological dominance and being the birthplace of a lot of innovation, Silicon Valley, et cetera. I think limiting free trade or forcing it so these companies are not able to import the technologies or the chips or the electronics that they need is not something that is probably a good fostering of innovation.
Yeah, and I mean wherever this tariff policy does end up being, it seems pretty unlikely that it would just be completely widespread
Yeah,
blanket non-discriminatory tariffs against all countries,
yeah,
all industries. There's probably going to be exceptions for certain countries. There's
yeah,
probably going to be exceptions for certain sectors, and so as we sort of progress, we'll see that
yeah.
cleared up a bit more.
It's good to see that they're at least thinking about they're at least thinking about making certain sectors uh, maybe have specific tariffs or less than just
Yeah,
being broad based. So
definitely.
we'll see what happens this next week. We're watching the headlines just as you are, and we'll be back with an update come Monday of next week. Thank you.
Thank you.